Sanlam Private Investments aims to provide above-average total returns over 3 years or more by investing in quality ordinary shares listed on the JSE. SPI's equity fund was founded in April 2011 with the purpose of offering private clients financial services on a bespoke basis. SPI's director, Alwyn joins us from our Cape Town studios to share their investment strategy within the volatile macroeconomic environment. What can I say, Alwyn, since we last spoke, more volatility. We've now got risk off back in the system, 850 on dollar rand. So one thing for sure, as I said to you last time you were in the studio, we can bet our bottom dollar that we've got volatility going forward.
Yes, we've just got to learn how to deal with it. And it is an extremely difficult environment, I think, to take very bold decisions, particularly if you're short-term minded. I think for longer-term investors, as I said previously when I was in the studio, I think it is very important that one should just see where value emerges. And I think in certain areas, particularly in global markets, value is starting to emerge.
Alwyn, how do you see that value in the local market? Not so long ago, we were at an all-time high. How would you characterize value offered by the South African equity market?
Yeah, it's a far more difficult question because in my mind, our own market is quite binary at the moment. What you find is that the defensive shares are quite expensive. And with defensive shares, I mean shares like SA Breweries, British American Tobacco, some of the food producers, of course the food retailers. Those shares where you generally have a high return on equity, market participants or investments are quite prepared to pay high multiples for those shares. On the other hand, the more cyclical part of the market, the resources in particular, are quite cheap at the moment. So if you look at the price earnings multiples of shares like Anglo American and BHP Billiton, those shares are all trading at multiples below 8 times. So if you want to go and buy value at the moment, undoubtedly, I think you will add more risk to the portfolio. And again, I think it will depend on the time frame that investors have in mind. It is very interesting. I just looked at Anglo American and I did a regression analysis on the price earnings multiple and of course the prospective returns on Anglos. And on a 5-year basis, there was only one reading going back to 1970, only one reading where when you bought Anglos at a historic price earnings multiple of below 8 times, where you didn't grow your money over a 5-year period. So I guess for those people who can afford to be patient, they can start to invest in that particular area, but with the volatility that Bronwyn referred to and the very uncertain macro environment, it might be quite tough to sit with that position in the short term.
Alwyn, what's your level of conviction on Anglo American? Having done the study you've just alluded to, would you be accumulating into the dips? We're currently trading at 266 Rand, so any pullback, buy fervently?
Bronwyn, it really depends on how much you have in your current portfolio and whether you're dealing with existing money or new money coming into portfolios. We don't have any problems with new money coming into our client portfolios to add to Anglos at these particular levels. However, again, it's a question of how do you put all the shares together in a portfolio that makes sense. Now, should you take cognizance of where the Aussie is, I would certainly not go to a full weight in Anglos because I just think in the short term the uncertainties are immense. But as I said, with a long-term view, I will certainly buy. We currently carry a weight of about 7 or 8% in our portfolios in Anglos. In the Aussie, the index weight is about 10%. But in the sector as a whole, I think one should still be pretty cautious. And you should certainly not have an overweight position in the sector given the short-term uncertainties.
Alwyn, if you look at the other sectors, particularly on the financial sector, how are you placed with regards to the banks? I see you've got quite a big exposure to First National. Do you think that the banks generally offer value?
Yes, I think relative to other shares in the South African market, the banks are still, I think, reasonably priced. Most of the banks trade at a price to book value of somewhere between 1.8 and 2 times. And in the case of First National Bank, you refer to that, you know, it has generated a return on equity of just over 20%. So I think it is at least fairly valued. You get a pretty decent dividend yield. And I think the bad debt situation is certainly eased for the banks in general. But that is if you look at our banks in terms of its peers in South Africa. For the brave people, of course, if you look overseas, you will probably find that you can buy a decent quality bank at a price to book of less than 1. I think a good example is HSBC, where you pay a price to book of about 0.5. So they're certainly much cheaper, but of course they didn't generate the same ROEs as our own banks. But if you are quite comfortable that the balance sheets of those banks are pretty clean, of course the risks are higher for those banks compared to our own, I would certainly, if I have the ability, I would certainly prefer overseas banks to our own. But for South African portfolio, I think a decent holding in banks is certainly justified.
In the SPI equity fund, you've obviously got in the top 5 holdings, your top holding is about 14% exposure to the Global Best Ideas feeder fund. Is that going to give you the exposure that you're talking about to the global banks?
Exactly right, Bronwyn. If you look at the constitution of the fund, about 35% of the portfolio is exposed to global banks. Then you've also got to take into consideration the fund has been managed by Kokkie Kooyman, and Kokkie for the 2nd year in a row last year won the prize for the best financial services fund globally. So I'm quite comfortable in terms of his stock picking abilities in the sector. And apart from that, if you look at the strategy and the philosophy that the fund has employed, they are clearly bottom-up pickers, and sometimes it comes with a bit more volatility, because sometimes I do find a small cap or medium cap share which has got serious value associated with it, but in this environment where people are worried about the business models of some of these smaller cap counters, the share price might not reflect the better quality that Kokkie might perceive in the particular share. However, since the beginning of the year, I think the fund has been, it's very short term, but the fund has been, I think, the 2nd best performer in the South African feeder fund universe. So we're quite happy to have it in the portfolio, and it really gives us the exposure to the cheaper overseas markets.
Alwyn, if I look at the breakdown of your portfolio, it's fairly well spread. By that I mean it's got exposure to all the key sectors, and within that I would say it's got exposure to some of the larger cap stocks like Billiton's and Anglos. From your perspective, what are you waiting for to happen in order to position the fund more aggressively? And I don't mean more aggressively in the sense that you're not positioned. I'm saying where you take a more rifle shot type bet within the fund. What is it that would make you have more conviction within it?
Kevin, maybe I was just respond to the rifle shot approach. If you look at the number of counters in the portfolio, we only hold 16 or 17 shares in the portfolio. So if you compare that with other general equity unit trusts, I guess you can clearly argue that we have taken a rifle shot approach. In the top 5 that you have in front of you, of course, you will see household name blue chip shares. But if you drop one level lower, you will also find shares like Pinnacle Technologies, you will find Wilson Bailey Homes, which is arguably quite an aggressive bet to take at this particular point in time. You will find African Bank in the portfolio. So I would certainly say that we have taken a rifle shot approach if you just look at the number of counters. To give you an indication, if you look at Alan Gray's General Equity Fund, they've got 91 counters in that portfolio. So it looks a bit different to theirs, at least. However, I think when you talk about aggression, for me, it would be where we start to reduce the exposure to some of the defensive shares. And if you say, what do I wait for? You certainly can't wait for certainty, because once you see certainty, those second liners and some of the shares where people have question marks about the ability of the companies to generate superior earnings, those shares would go through the roof. However, I would, at the end, you manage other people's money, and in this macro uncertainty, I would certainly not be too aggressive in really increasing the cyclicality in the portfolio at this particular point in time. So should you get a serious markdown of some of these cyclical shares, and what I would probably look for is significant weakness in commodity prices. I'm not talking about the commodity shares, commodity prices, because then I would think that the market has realized that we really are in for a tough period from a macro perspective. The share prices will reflect that, and I would certainly use that as an opportunity to increase the cyclicality in the portfolio.
Just looking at that resource exposure and coming back to it, as Kevin pointed out, sitting at just under 21%. Your view on Sasol, is it in your portfolio? Because if you look at what's happening right now, obviously you've got oil, Brent crude at just above $90 a barrel, and then you've got dollar rand a short while ago trading at 8.50. So weaker rand works in Sasol's favor, but obviously you've got a potentially dramatically falling oil price. Some people are tabling that we're going to go even lower than these levels. What are your thoughts on Sasol, Alwyn?
Problem, we've got 4.5% exposure to Sasol, which is again an underweight relative to the index for what it is worth. But if you have 4.5%, you would like it to show a positive performance. Otherwise, you shouldn't have it in the portfolio. Personally, I think that the dollar oil price can come under further pressure. The way I look at the oil price, it's so tough to forecast. But I like to look at these commodity prices in real terms, in terms of its own history. And these commodity prices are still not cheap. If you look at the share price itself, it looks at least fairly priced. It still provides a pretty decent dividend yield. The Synfuel business, we know it is a very good business. It generates good cash. What I would like to see, we will get a letter from management, I think, in 2 days' time. What I would just like to see, if they can't generate decent profits with new ventures, I would just like to see them to return the cash back to us, and then we can make the capital allocation decision. But at the moment, the slightly underweight position in Sasol is one that I'm pretty comfortable with, and hopefully we'll get more clarity when the news comes out from the company itself.
Are you also waiting for money back to you, Kevin?
Oh yes, I'd love money back. Can I just ask Alwyn
one more question?
One quick question. Alwyn, in terms of the portfolio, what is the dividend yield on it? Is it something that you focused on at the moment? Are you looking at stocks that are paying a higher dividend?
No, it is not one of our objectives to build a portfolio with a high dividend yield in this particular portfolio. As you know, we run private client money in a very bespoke way, and for many of our older clients, they do have the need for dividends, and for those clients, we construct a portfolio quite comfortably, where we can put a decent portfolio together with a dividend yield of about 6%. The current dividend yield of this portfolio is closer to 3%, so you can clearly see that it's capital growth and not necessarily the income growth that we ultimately target.